Welcome to the Business Coach series, where we look at a number of topics relevant to any business coaching program. Specifically, today, however, I would like to look at the finance and strategy and make sure that your coach is at least covering these topics. So when we look at strategy, what is it? Really, there are four questions that we always look for. The first is, where are we now? We have to know what our base is. We need to know where we want to be. And then, how are we going to get there? And finally, how do we know that we're on track? So it's perhaps one of these last elements, this last question that we really want to focus on today. And one of the things that we want to do when we're actually using finance to look at strategy is really trying to predict the future. And from a financial perspective, we want to make sure that there's enough cash flow so that we don't grow broke. And we want to ensure that the long-term investment strategy that we have is going to actually create pleasure and not pain. So let's look at each of these elements quickly in turn. So, will your business grow broke? Simply put, it's determined by your marginal cash flow. It's the case of what is the difference between your gross profit and your working capital absorption percentage. So what are those? Most people know what a gross profit is. But the working capital absorption percentage is a measure of how much money you've actually had to put in to actually make the business work on a daily basis. And it's a function of your accounts receivable, your accounts payable, and the level of inventory or work in process that you have. When we look at this, why do we look at it? It's simply put is that when you have a dollar of sales, you're going to get a certain money back from that dollar that you've invested into the purchasing of that product, and that's your gross profit. Then you're going to have invested money to make that happen, and that's your working capital. So what we're looking at is the money that I'm going to get after my sale greater than the money that I've had to invest? And this is determined by your working capital and your gross profit, and it's called your marginal cash flow. It's the case of many businesses who aren't structured properly have a situation where their working capital absorption is much greater than their gross profit. It means that the business owner has to invest either through equity or debt for every dollar of growth. And it's in this sort of situation that a business can quickly run out of cash. It's an unknown but commonly accepted fact that most businesses that go under and close their doors for the last time are actually profitable when they close, but they've run out of cash. And this marginal cash flow is one of the key measures of identifying what's going to happen and predicting the future. When we ask this pain or pleasure question, however, it's a little bit more complex. So let's take a look at it in a little bit more depth. What we need to know is that from a business management perspective, it's absolutely critical that every business owner and manager over time is focused on growing the EBIT or the profitability faster than they're growing the investment in the assets. So you might ask, why is that the case? Well, let's take a look at it in a question of how sustainable the growth is. If we look at this graph and we recognize that where you need to be is, if you're looking at the bottom axis, that's your growth in capital or investment in your assets, and the vertical axis is the profitability. So looking at this graph, if you're in somewhere in between quadrant A and B, it means that you're actually reducing your asset base and improving your profitability. Now, in other words, that's a form of cost cutting because you're cutting down on your assets. So what does that actually mean? You might actually be optimizing it, and in which case it's great. But the truth is, over time, there's only so much assets that you can cut out. And the impact is that this is not a really sustainable process for the long term. On the other hand, if you are reducing both your profits and your assets, you're definitely in a form of re-engineering. And very often that's a re-engineering that leads to closure. So one has to be very careful if that is where you're operating. On the other hand, in this quadrant between C and D, what you're seeing is a business that is increasing its asset base, but again, reducing the level of profitability that it's getting. It means that it's absorbing cash, and your free cash is being absorbed quite quickly in this quadrant. So in retrospect, when you look at this, you realize that you've only got one quadrant where you've got growth. And the question is this fast growth or slow growth? And obviously we want to be closer to where the fast growth is. So to answer that question on pain or pleasure, you recognize that where we need to be is very close to that A-axis. That's the area that is ensuring that your investment strategy, your operating strategy, and your business model is actually going to give you pleasure over the long run. So let's look at a quick case study. Acme Suppliers, I've changed the name to protect the guilty. However, when you look at this, looking at their revenue growth, they've actually doubled their sales in a 3-year period. So their top line has doubled. That's amazing. That's fantastic. And it's really good news. When we look at their profitability, that's grown even faster. So they've actually been growing profits faster than they've actually been growing their revenue. That too is a fantastic place to be. However, when we look at the free cash flow, we see that there's a problem. And their free cash flow is going in the exact opposite direction of where you need to be. That in turn, as you can see, is driven by this increase in the investment in the assets. And it's shown up very quickly in this graph, where you can see that in 2015 they were in the right areas, but 2016 and 2017 they've been investing too much. So we've had to go in and look at this business and come up with a strategy that actually minimizes that and returns them into a sustainable growth phase. We've had to say no to a couple of the investments that they're making. And I suppose that is also the point that I want to make. Just as what strategy helps define what you will do, it also helps define what you won't do. And perhaps the biggest lesson out of that is that saying no is sometimes the most powerful decision you can make. So, to summarize, finance enables strategy. And by setting targets for revenue growth, GP percentage, working capital, and a number of other metrics, we actually get a true understanding of the business performance. We know which quadrant the business is in, why, where we're going, what has to happen, and it gives us an idea of what the realizable business opportunities are. And even more than that, it gives us a better idea of the outcome of what's going to happen in the business. So, to summarize Peter Drucker, to paraphrase him, strategy does not deal with future decisions. It deals with the future of present decisions. If you'd like to know more, my name is Charles Barnard, and I can be found via my LinkedIn profile.